Good afternoon to everyone in Germany. Good morning to everyone in the UK. Welcome to our webinar of today, doing business between the EU and the UK, and especially moving between the EU and the UK. Today we're in Munich. I have my good cooperation partner, Thomas Adcock from Gravita in London with me, and we will tell you well, the bits about what happens when you move between Germany and the UK, or when you start doing business between those two jurisdictions. One thing up front, it will all be like the big high-level lines. Any questions are very welcome. Please post them in English so Tom can also understand them. And any follow-up questions afterwards, please do not hesitate to reach out to us personally. So Tom, over to you.
Hello everybody. Just to quickly introduce Gravita, which is the firm that I come from. We are a fairly new beast. We've been around about a year or so because we are a collection of three very similar sized firms that have been around forever and knew each other very well, and two slightly smaller ones that have joined the party. We are now a top 30 firm in London. We've got 400 and 450 people with full service and delivering all of those services and a few more that are listed on the right hand side of the screen. Little bit about me. So I'm a tax partner at Gravita. I typically advise clients all over the world how to navigate the UK tax system. So be you a business or a family coming and going from the UK, I'm one of those people to call. So that's a little bit about me.
And then about PSP, for those who do not know as yet, we're a full service firm based in the center of Munich. We offer anything that comes along with the legal aspect, auditors, tech consultants, and we have a family office. We mainly advise large and mid-sized enterprises with our particular expertise in family managed businesses. And our clients also include wealthy individuals as well, foundations, non-profit organizations, private equity firms, and also some DAX groups, so German listed entities, as well as international clients. My name is Janneke Speetjens. I'm a partner in the tax team of PSP. I'm originally from the Netherlands, as you may hear in my accent, and I've been practicing German law and tax law for the past 8 years now. I mainly focus on inbound clients, so everybody that's from abroad is very welcome to contact me, and me and my team will assist you with any questions you may have. And now we go to the more interesting parts, being what happens if a German person, family, business decides to move or expand to the UK.
Absolutely, thank you. So coming to the UK, it doesn't look like that at the moment. When I left London yesterday, it was raining, which was lovely. So coming to the UK, we've come up with a sort of fairly normal scenario just to explain the rules and how they would apply to them. As Janneke said, we'll keep our presentation very high level. There's a lot more detail underneath, but this is only a 45-minute, hour-long slot, and we'd have to take 3 days to really go into the deep dive on the issues. So what are we looking at? We're looking at a German family which has decided to move from Germany to the UK. They're going to buy a home in London, and their children will be going to school in London. The husband will continue to work for his global employer, and his wife will continue to run and work within her German business. They're going to retain their German home and all the other financial interests they have in Germany. So from a UK point of view, what do we need to think about? We need to think about tax residence. We need to think about what's called the remittance basis and what might replace that, which we'll come on to in a little bit. We have to look at UK inheritance tax, and then for her particularly, we need to think about corporate tax residence and the concept of exit taxes, both coming and leaving the UK and Germany.
Yeah, so about exit taxes, the last point that you mentioned there, many Germans will have heard of it. if a German tax resident decides to move to another jurisdiction, German excess taxes may come into play if you own shares in legal entities. So that's something the family will have to take into account here and keep in mind here. And that may as well apply to any German businesses.
Right. So coming to the UK tax residents, we're very strange in the UK for lots of reasons, but one of them is our tax year. We run it from the 6th of April to the following 5th of April. So that is our tax year. There's nothing sensible about it, other than the fact the 6th of April happened to be the day after the very first budget in the UK. That happened 200 years ago or something. So you would have thought they would have updated it, but they haven't. Somebody who is a UK tax resident is tax resident for the whole of the year in which they are tax resident, unless the split year treatment might apply. And if you are tax resident in the UK, you will pay tax on your worldwide income and gains, unless you can claim this remittance basis thing, which we'll touch on in a minute. UK tax residence is determined by what's known as a statutory residence test, which is like a flowchart. And the flowchart is here. It's a very small screen for what is quite a long flowchart. Hopefully you can see it, but broadly speaking, you start from the top, you work your way down. But as soon as you hit a condition that meets your circumstance, you stop there. And if that means you're non-resident, then you're non-resident. If it means you're resident, then you're resident. And it's only if you miss out on those first two automatic tests that you work your way into what we call the connected factors tests, which depend on whether or not you're an arriver or a leaver. It's all based on day counts, a day being a midnight, and it does bring some certainty and some consistency into the UK tax system. It's been around for over a decade now, and we all quite like it. But tax residents, like all things, when you're talking about two different jurisdictions, is all subject to double tax treaties, and of course we have one with Germany. So we need to establish, if you are tax resident in the UK, you may also be tax resident in Germany. You will have income and gains in both jurisdictions. So who gets first bites of the cherry, or who gets to tax it entirely?
And there may be another point you just mentioned. You may also still be resident in Germany for tax purposes. And that is, of course, the case, probably, very likely, in our scenario,
Absolutely.
because based on German national law, a person is tax resident in Germany if they have a place of residency at their disposal. In our scenario, the family kept their place of living in Germany. They did not sublet it or rented it out to anyone else on a long term. So very probably these people are still resident for tax purposes in Germany as well. So we will need the double tax treaty to, well, make sure they don't pay double taxes.
So this remittance basis, it's a very old established concept in the UK. It's all based on what's called domicile. Domicile is not a tax concept in the UK. It is a legal concept. It broadly means where you are from or where your father was from.
Only your father?
Only your father. It's slightly strange. It's a very antiquated thing. It's trying to follow the lineage of your family to establish where your family was from. So if you're Belgian and your father was Belgian, then you're probably Belgian. It needs updating, it needs change, and I'll come on to that potential change in a moment. But if you are not domiciled, or what we refer to as a non-dom, I think quite famously, Rishi Sunak, who's the current Prime Minister of the UK, his wife is as a non-dom. You can claim the remittance basis, and you can protect all of your non-UK income and gains. So anything that arises outside the UK whilst you're UK tax resident from UK tax, as long as you don't remit, which broadly speaking means use, in the UK. Now, historically, this used to be free forever, but a few years back now, they started bringing in costs to applying this. But for the first 7 years that you're tax resident in the UK out of 9, it's free. Then after that, it starts to attract a fee. It's not a tax, it's a fee. So you pay 30,000, then you pay 60. But once you've been here for more than 15 of 20, then you'll be deemed domiciled in the UK and treated like anybody else who was from the UK originally.
So maybe also to jump in there, that sounds very wonderful, but people that want to apply the non-dom rules, they need to be aware that depending on where they come from, their country of origin may have certain anti-abuse rules in the double tax treaty or in national law that could state that if you use the non-dom rules and the remittance base, then anything that's not taxed in the UK is not protected by the double tax treaty.
Absolutely. So there are some potential dangers to the use of the remittance basis when we're talking about globally mobile people. So earlier this year, the UK's current government, the Conservatives, announced a broad update, change, scrapping of the current non-dom rules from April next year. Most, if not all of you who are listening to this will be aware that the UK is going through its election process at the moment. The election's on the 4th of July. And so all of what is on this slide is subject to material significant change. It is, however, understood that the policy, which is what this is, that was produced and released by the Conservative government, was a photocopy of what the Labour Party had come up with, which is the opposition party currently in the UK Parliament. So we are hopeful that this is broadly in line with what we can expect either from April next year or perhaps from a future date to come in. It is frustrating that we don't have anything more than this to talk to clients about because we have the press release and only the press release that was released at the time of our budget a couple of months ago. But there is some interesting things in here. The first thing is important to note, the concept of domicile is gone. We will only talk about residence of individuals, which makes a lot more sense. The second thing to note is that they have brought in some opportunities. So if you are someone who can benefit from this, then as part of your planning to come into the UK, leaving income that grows or rises after you've come to the UK and gains that grow after you've come to the UK outside the UK tax net until these rules come in to play may be very beneficial because you might be able to bring it, that money in at the rate of 12%, not potentially at 45%. So there's a nice thing there. Equally, for certain people, they'll be able to only declare half of their overseas wealth to the UK tax authorities going forward for the first year, and then some other nice pieces in there. On the bad side is it won't apply all that long. So the concept of 15 out of 20 will be replaced by one of only 4 years. The nice thing about that is, though, as I say on the left-hand side of the slide, this is one of those gives and takes with equal degree, is that for the first 4 years, even if you do bring the money in from overseas into the UK, you won't pay tax on it in the UK. This is a very nice thing. How that's going to work with double tax treaties that Janneke just mentioned, we will see. But there are some good, there is some bad to the potential new rules that will be introduced. Right, inheritance tax. Inheritance tax is all about domicile again. So we're anticipating if the new rules come in, then inheritance tax rules will be updated. But currently it's about domicile. Okay. So someone who's domiciled in the UK, no matter where they live in the world, is going to be subject to UK inheritance tax on their worldwide assets. For someone who's not domiciled in the UK, like this family coming to the UK from Germany, it's only UK citus assets that will be caught with inside the UK inheritance tax net until they've been in the UK for more than 15 years.
Yeah, but there, luckily for the German family, they kept their residency in Germany, which means that they're still treated as a tax resident from a German point of view, which also means that they will still be fully subject to German inheritance tax and gift tax as well. So inheritance tax here, the UK has it as well. In this case, we would probably even run into double taxations, and we would need national regulations in order to, well, see whether we can have any crediting or what have you to prevent any double taxation.
Yeah, I'm not sure lucky is the right word, but it's certainly true. Problem with inheritance tax is the rates. The rates of inheritance tax in the UK are 40%, which is very, very high. There are a large number of reliefs, business property relief being the main one, so that will almost certainly apply to the wife's business because that will almost certainly qualify for that relief. But things like homes, other property you rent out, cash in the bank, is all going to be caught by inheritance tax. Now, I know for our German listeners, trusts are perhaps not common from a structuring point of view. They are very common in the UK, both for onshore and offshore planning. Therefore, when we talk to people who are coming to the UK from overseas, we really do talk about trusts a lot to explain their benefits, particularly from an inheritance tax perspective, because it's possible to use non-UK trusts to shelter foreign wealth from UK inheritance tax pretty much forever under current rules. That may change, but as we stand today, that can work. The only time it doesn't is UK residential property, either whether it's held directly or through corporate structures or whatever else. That's always within the scope of UK inheritance tax. We can't avoid that. Final thing is to talk about, when coming to the UK, to talk about corporate tax residence. Much simpler, to be honest. There's no very long flow chart. There are 3 conditions. A company's tax resident in the UK is incorporated there, if it carries on a trade through a UK permanent establishment, or if it's managed and controlled in the UK, which is going to be the piece that perhaps matters most here with our example, which we'll come on to in a minute. But all of this is subject to double tax treaties. Exit taxes, as Janneke has touched on before, we are slightly different to Germany. We don't have an exit tax on individuals. We have temporary non-residence rules, which we'll talk about a bit later. But we do have an exit tax for companies. So if a company does leave the UK tax net, it's deemed to sell and then reacquire all of its underlying assets. And to the extent those assets have left the UK tax net, there's a tax rate on that profit, if there is one, of 25%.
And would that apply to a permanent establishment being incorporated in 1 year and failing to meet the requirements in a year later?
No, that's a very good question. It can do. It depends on what that permanent establishment has, whether there's any value to it in and of itself. So if it's created intellectual property, which is a UK citus, then yeah, it could definitely apply to that. But it wouldn't happen perhaps to, say, a factory that had been bought in the UK and was still retained by the business, because the factory hasn't left the UK tax net.
Okay.
All right, so just the application of on our scenario. So just to remind you, we've got a German family coming to the UK with their children. The husband's going to continue to work for the global business, which is an employee of, and his wife is going to continue to run and work within her German business. So they're almost certainly going to become tax resident in the UK. Janneke has confirmed that they're going to almost certainly retain their German tax residence as well. So we have to look at the double tax treaty. Sorry for the acronym DTT, but it's too long a thing, keep saying. Tiebreaker clauses, which broadly run as, do you have a permanent home? Well, we've got one in both. We've got a house in both countries. Where's our centre of vital interest? Tricky. It might be balanced between the two. Centre of vital interest, where's your wealth, where's your family? They're probably in both places. So difficult to really arrive, I think, from a UK perspective on exactly where that would be. Where is the habitual abode? Again, potentially challenging. We might be living in both countries. We might be using them both as the place that we live most often. So we're probably going to fall onto where they are nationals. And it's very likely that given such a short period of time, they won't have become UK nationals. That does take a little while in the UK. So they would have retained their German nationality, which I think under the double tax treaty would probably find them as tax resident rather, treaty tax resident in Germany. Which may have some benefits from a German and UK tax point of view. If they weren't nationals of either, just so everyone knows, there's a mutual agreement between the countries we have to fall on. That is a painful process. So it's better to fall within the earlier ones.
Yeah, the mutual agreement process, that's a long process, and tax authorities are not very keen on entering that process. So it's usually good if you can find a solution based on one of the previous bullet points.
Absolutely, definitely. Just a very, very simple bit of pre-planning, and this applies to all people coming into the UK from overseas. If you do have overseas wealth, make sure you separate out your future income and gains from your what we would refer to as clean capital. It makes life much easier, and the reason it makes much life easier is that if you want to bring money into the UK later, so once you've become tax resident, the rules work that it's worst case scenario. So if you've kept new income interest, say, arising into your overseas savings accounts, then if you remit the money into the UK, it will go through the savings income first before it gets to the capital. So it's very important to split them into separate accounts. Most banks that have any dealings with people who come to the UK have something called the non-dom package, and I would suggest that anybody who's going to do this uses one of those. And again, non-UK trusts, always think about settling a non-UK trust, even if you're from a jurisdiction that doesn't trust them, because I think it's a good idea.
Yeah, and in that respect, from a German point of view, again, always contact a German advisor. It holds, by the way, for the other EU countries as well. Always contact a tax advisor up front before doing that, because there are many situations in which certain EU assets can already, from a civil law point of view, not be legally transferred into a trust-like entity or form. And again, if it's possible at all from a civil law point of view, then putting assets into a trust may, from a German point of view, from many other EU jurisdictions, it may be considered a gift tax triggered, or it may cause certain income tax consequences. So this is a point. Always make sure to include advisors from both jurisdictions before doing anything.
You can certainly see where the complexities come. Hence, we're trying to keep it's quite high level. Right. So the German company tax residence, just to focus on that very briefly, it's highly likely that the German company will become tax resident in the UK by virtue of being managed and controlled from the UK. Unfortunately, the double tax treaty doesn't protect against that happening. In fact, it states that where management control is where the company will be tax resident. The company is likely, therefore, to be subject to tax as follows. In Germany, on its German permanent establishment profits, again, apologies for using acronyms PE here, it would be then taxable in the UK on its total profits, with a credit for the German taxes on the German permanent establishment profits, and then finally, probably under German rules in Germany, on its profits, relief for UK tax due. So this becomes a bit of a compliance headache as much as anything else. So what do we do instead? What do we look to if we can do? It's not always possible, but we look to maybe establish a UK subsidiary of the German company to try and put just the UK activities in and keep the two separate. We definitely consider appointing German residents to the board, but we have to make sure that those German residents actually act as board members. They actually are directors. They're not rubber stamping decisions that happen in the UK. And again, settling the German company into an offshore trust is something we would think about doing, subject to advice.
And the Germans would probably have a problem with that.
Yeah, sure.
But we can always discuss it. Yeah, and that's maybe also one step back to the slide for all German listeners. You may see that on the second last bullet point on the left side, it says in the UK, taxation on total profits with credit for German taxes. In Germany, we are kind of used to having exemptions under double tax treaties, but with the UK double tax treaty, the UK is applying a credit system. So that means full taxation in the UK and then just crediting any taxes that were paid in Germany.
Yeah, we like keeping things complicated. Apologies for that. So coming to Germany.
Yeah, we are now turning things the other way around. So in this case, a UK family decided to move from beautiful London to Germany, also very beautiful here. They will be buying a home in Munich. They can afford that. And the children will also be going to school here. There are some nice international schools here, so they will be able to go to a school where they speak English. The husband will be working for his global employer with its seat and place of effective management in Munich, and his wife will continue to run and work within her UK business. They will also retain their London home and other financial interests in London, and they plan on staying in between 8 to 10 years because they want their children to finish their school here in one place. So what is there to think about upfront, to consider upfront with the tax advisor here in Germany? First of all, the question of tax residency, always good to check upfront. In this case, I'll come to that later, but I would say it's quite clear here. Then it's good to be informed about German income tax taxation, especially also about German inheritance tax and gift tax. Gift tax may be something new for UK residents. Corporate tax residents, so the residency of the businesses, and then again, for once the staying period is over, potential exit taxes on moving away from Germany. So what are we looking at for the tax residency? In Germany, we look at it from a national law point of view first, and there we have two requirements that could lead to you being regarded a tax resident, an unlimited tax resident for tax purposes in Germany. So the first one is the place of living, a residency in Germany. So it means that you have a residency at your disposal in Germany. It must, for example, it must be suited to fulfill living requirements. You must be able to enter it at your wish. This may already be the case for vacation homes that you maybe only use once or twice per year, or also for pied-à-terres, for example, having a key to the house of a sister in Germany, where you have a room that's furnished for you and your stuff is just always there. Those kind of things can be like in the gray area, and it may be tricky there, but you have to watch out. The other reason why somebody may become unlimited tax resident of Germany for national law purposes would be having an habitual abode. So in German, for the German listeners, it would be the gewöhnliche Aufenthalt. And there we basically look at, did you within a 12-month period spend 6 months or more, that 6 months or more that are related to each other? So short breaks do not really interrupt these 6 months in Germany. And if that's the case, you usually run into having an habitual abode in Germany. There are some exceptions, for example, when you're solely for visiting or vacationing purposes in Germany and not exceeding a stay of 1 year, but educational purposes do not count as visiting or vacation. So if you come here for a course for whatever reason, and you stay here for 3 months or for 7 months, then you may be within the habitual abode rule. So the tax checklist that you definitely have to check before relocating yourself to Germany is, do I need to reconsider any director or board positions I have in UK businesses? Yes, you do, because as Tom already mentioned before, for tax residency of legal entities, we usually look at where is the place of effective management. And usually in practice, it turns out to be the place where the director or board member lives, because they practice their day-to-day management from that place. It may sometimes be different, but the German tax authorities clearly take the position that if you cannot prove that when having a business and you state, well, no, my place of effective management is still the UK, but you cannot properly prove that to the tax authorities, then they fall back to the place of living of the director or the shareholder. And in our example, that could be an issue for the wife in the family, because she has her UK business. Am I involved in any trust, for example, as a settlor, a grantor, a trustee, or a beneficiary? If yes, and we already touched upon that, trusts are a tricky thing within the European Union, and especially also within Germany. Please do have the situation checked for potential tax consequences before establishing a tax residency, because once you're in, it will be difficult to make any changes without triggering the tax consequences of those changes. within Germany or the other EU jurisdictions.
Yeah, and sorry, just to jump in, it's also important from a UK point of view that if the trust migrates its tax residency status out of the UK, it could trigger tax issues in the UK as well for the trustees and potentially for the beneficiaries, depending on how the trust is established. Coming back the other way, it can actually have really positive effects, usually from cost, though. Most offshore trusts are managed out of different jurisdictions where the costs can be quite high. And so bringing them into the UK, you can sometimes do that without triggering any adverse tax consequences, but also reduce costs of managing those trusts.
Exactly. The next point is, am I expecting or intending to make any bigger gifts in the near future, or am I expecting any inheritances? That's of course something you cannot really plan, but we're talking about the gifts now. And so as I already mentioned, as of the moment you become a German tax resident for national law purposes, regardless of whatever double tax treaty may be applicable for income tax purposes, you will be considered to be fully subject to German inheritance and gift tax. And we only currently have 6 double tax treaties regarding inheritance and gift tax, and the UK is not one of the countries we have one with. This means that upon creating a German tax residency for national law purposes, every gift you make will be subject to German gift tax. So you should consider making any gifts before establishing a tax residency.
And actually, this is one of those areas where the two tax systems, while very different, actually align, because there's no harm in making a gift in the UK as long as you survive that gift by 7 years. It is the only piece of tax advice in the UK the guy down the pub gets right. Basically, if you, in UK tax purposes, if you gift something to someone else and you survive that gift by 7 years, it's no longer in your estate, it's gone for your inheritance tax purposes. And we don't operate currently a gift tax. And so giving the funds to someone else prior to leaving the UK doesn't harm the situation in the UK.
That sounds good. So what are the main consequences of having a German tax residency? So in the first step, natural persons, private individuals, they will become subject to German income tax on their worldwide income or deemed income. We have some deemed income regulations in Germany. So that's for everything that arises as income whilst being tax resident, except to the extent that such income is, that such taxation rights are limited by a double tax treaty. And this will apply from the date residency is established. For the year of relocating, so for example, the family would move now as per the 1st of July, they would move from the UK to Germany. We do not only have to look at everything that is generated after the 1st of July, but we also need to take into account anything that was generated in the first half year of 2024, because Germany levies its income tax based on a progressive tax rate, and any income accrued or well, any income generated before in the same tax year before moving to Germany, and the tax year in Germany is the calendar year, may be included for purposes of calculating your tax rate. So it will not be taxed as such, but it will be included for determining your tax rate. There are some exceptions to that, but it's something to be aware of. So you cannot like play with that. It will be taken into account anyway.
We don't apply the same rule in the UK. Your tax, if you come in the 1st of July, you'll be taxed on your worldwide income and gains as of arising from the 6th of April, unless the split year treatment applies. So we do tax it unless you can hit the conditions, and the conditions for split year treatment are very difficult to hit. There's a long list for each of the cases, and if you miss one little bit, you don't qualify. So it's always best to assume that you'll be tax resident for the whole year and plan to be tax resident for the whole year.
Yeah.
So a slightly different approach.
But there we could probably, going back to your example of the German family moving to the UK, we could probably fall back on the double tax treaty for the period before them moving.
Yeah, probably.
Okay. Okay, so if you want to move to the UK, you'd better do that as of the 6th of April.
Yeah, arrive on the 6th of April makes life much easier for everybody.
Okay, very good. Some other consequences of having a German tax residency, again, for national law purposes. We have some CFC rules. So in German, for German listeners, it's the Hinzurechnungsbesteuerung. That CFC rule allocates income from foreign trusts or family trusts and family foundations to certain persons such as settlers and beneficiaries that have their place of tax residency for national law purposes in Germany. Most double tax treaties also accept that rule. It's of course a treaty override, so it means Germany does not comply with its own agreements it made in the double tax treaty. So they said single-handedly, they said, well, we're not going to apply those and those rules. We are going to treat it like this. And these rules we have by ourselves, they take precedence over the double tax treaty rules. But regarding these rules, most double tax treaties Germany has clearly state, okay, but German CFC rules, they can apply it regardless of whatever we agreed on in a double tax treaty. We also have CFC rules for companies outside of Germany, so not only foreign trusts and foreign foundations or family trusts and family foundations. That's important to distinguish there, but also for legal entities, limited legal entities. So if the family that moved to Germany from the UK, if they're still shareholders of a UK legal entity that is still fully tax resident in the UK, then still depending on the activities of that legal entity and of the tax rate that's levied, the effective tax rate that is levied in the UK at the level of that legal entity, the income of that legal entity may partially be allocated to the German family, depending on how much of the shares they own at certain other requirements. Then, of course, there comes a point where the German tax, the UK family exceeded a stay of 7 years in Germany. And after 7 years or more of German tax residency, again for national purposes, during the last 12 years, they will generally become subject to the German exit tax rules. That is not always that nice, or basically it's not nice at all to be in there. So exit tax rules basically try to cover any hidden reserves on shareholdings that private individuals have, and the exit rules try to cover those hidden reserves that arise up to the moment of exit. And the exit is not only moving away from Germany, that's also an exit, but an exit can, for example, also be a transfer of shares to a non-resident of Germany, with such transfer not being at arm's length. For example, transfer against €1, even though those shares are worth 2 million or something, can be an exit. The exclusion of Germany's right to tax the potential profit upon any disposal of shares, which can be the case if a double tax treaty changes, for example, that could also be an exit. Usually there is an obligation to file a tax return in Germany, not only in case of an exit, but if you have a German tax residency, even if you have no income. So that again applies to the family that moved from Germany to the UK. If they don't have any income that's allocable anymore to Germany, but they still have a tax residency, they still need to file.
Just a couple of quick points, from a UK perspective. We have plenty of anti-avoidance rules in relation to trusts and foundations and anstalts and all other means of creating structures, which look to tax individuals as opposed to the structure itself. But broadly speaking, there needs to be an avoidance motive in place in order for those rules to apply. And if you can do it from a family perspective and from a commercial perspective, it's usually possible to structure things in such a way that individuals only pay tax on the money that they extract from the structure. So that's how we try and structure. It's not always possible, and of course these things are subject to change. The The other thing that we don't have an exit tax, but what we do have is the alternative, is the other way of doing it. We have temporary non-residence rules, which again is an anti-avoidance device. Basically says, if you've got this family, they've left the UK, they've gone to Germany, their intention was to be there for 8, 10 years, but they get to Munich and they miss the British weather, although to be fair, in Munich today, you've got British weather, and so I'm wearing a jumper in June. They then go, oh, well, we'll go back to the UK. If they do that within 5 years, then they are potentially taxable on any income and gains that they have made since they left the UK. But of course, there are rules about when did they own the asset, when did they generate the income, from where did the income come from. But these anti-avoidance rules apply to these types of families which are moving around the world. So the trust rules, for example, might apply that whilst they're in Germany, they set up an offshore trust, they then come back to the UK and they try and benefit from that trust. They might apply in those circumstances, as an example.
Good to know. So now we are expanding the business to Germany. So this can be the wife, or it can be any UK company that wants to expand towards Germany. So what do you need to consider? Once more, you will have to consider the place of effective management. So if you have a UK company and you start performing the operational day-to-day management from Germany, for example, because all your directors moved to Germany or are in Germany, then we may have the issue of having a place of effective management in Germany. In that respect, there's one point to highlight, and that is unfortunately because the UK left the European Union, and that means that if a UK entity moves its, well, it's not its tax place of effective management, but its civil law place of management to Germany, and it has like a real true presence here in that respect, then Germany may see that legal entity from the UK as not being a legal entity at all anymore. Because in Germany, we look at legal entities based on the incorporation, or whether they comply with the incorporation requirements of German law, and we have kind of a limited list of companies we accept and recognize in Germany, and that basically means that the company has to be incorporated person to German law, and a UK company can never be incorporated person to German law. From a EU point of view, we have some rules that say, okay, but Germany has to recognize, has to accept the legal character of EU legal entities, but since the UK left the EU, those rules do not apply anymore to UK entities. So UK entities should be really careful there, because the consequence of falling within that civil law rule within Germany may mean that from a German point of view, the shareholder or shareholders of the company become directly liable for everything.
It's just two things. One, it's not a surprise you have a list of rules to disturb these things in Germany, but also page 20, and as when we first mentioned Brexit. And interestingly, having gone now through Brexit for the last few years, yes, it does create a lot of problems in the UK, of course it does, but actually never forget from a UK perspective just how many difficulties and problems it can cause in the EU as well, and this is just one of them, and it is a genuine issue. Now, there may well be a fairly simple solution about putting a blocker entity, we call it, in the gap. May or may not work, but it is something very much you need to really pay attention to. These kind of pre-planning, right? Understanding this problem. If you move your business and you migrate it into Germany, suddenly you're liable to everything of that company personally. There's a simple fix, probably, and it's worth doing in advance. So just pointing that out. Brexit isn't a UK issue. It really is also, unfortunately, to do with the EU too.
Yeah, it does. And of course, the other options you're talking about, I mean, one of them would be on purpose creating a permanent establishment that is then taxed in Germany. Downside of a permanent establishment from from a tax point of view is usually that it causes businesses a lot more administrative effort for tax filing purposes, for making separate trial balance sheets in order to make sure you allocate profit correctly. So what most businesses end up with doing is creating a German legal entity as a subsidiary. This also has the positive effect that you may already, if you're a company that also wants to import products into into the EU, you already have a EU resident entity within your group that makes things much easier from a customs and import.
We promised we wouldn't stray into VAT.
I promised you we would not go into value-added tax and stuff. I'm not going into value-added tax. Value-added tax is for another time. It will make it easier for wage tax purposes, for being allowed to employ people, obtaining work permit requirements, and that's the right side of the slide here. So the pre-planning, what's really important to do post-Brexit is check all work permit requirements for yourself, for your employees. That does not only hold for businesses, of course, also for individuals. There are some exceptions that allow you to do like a limited list of activities within Germany for a short period of time, but that's something you really need to check properly. So all work permit requirements for everybody that comes with you or with your business, and arrange this in time. So this does take time. Authorities will want to ask questions, they will want to see documentation, and processing times can take months. So don't think we can do this like in the last week before moving.
Same is true coming to the UK. All these things need to be checked off these days before you do it. And it can take a long time for those visas or registrations to take effect. So just be wary of that from a planning perspective. It's a shame, but it is where we stand right now.
Yeah, and the same holds for social security statuses. So also because of the Brexit, we don't have the easy A1 certificate process anymore. That used to be available in that respect. So basically, employees coming from the UK may, under circumstances, be subject to EU social security as of the first day doing something within the EU. Again, there are exception rules for that. There is some separate regulation for the time after Brexit. You may request certain certificates from HMRC that can be kind of similar to an A1 certificate, but it's all not what we're used to anymore. So it really needs to be checked.
It does, and you would think that after 4 years we would have some of these things resolved, but we don't.
Yeah, it remains very, very complex. One point still, and that's I think what many people do not have in their minds when they move from outside of the European Union to within of the European Union. So anybody entering crossing the borders of the EU may and usually will have to file customs declarations. So that already holds, for example, for a UK business sending a technician for a day to Germany and a technician taking some tools. It holds for a family moving to Germany. It holds for sending business products to the EU. So that's everything that changed with the Brexit and needs to be taken into careful consideration.
It really makes getting through German airport security nice and quick and easy.
Yes.
So that's been an excellent win for Brexit, I think.
It has. So one further point to consider when establishing a German subsidiary as a UK entity, please carefully consider which UK entity within your group, if you have the luxury of having a group, should be the shareholder of that German subsidiary, because we do not have the luxury anymore of being able to rely on EU directives in that respect for withholding tax purposes. We only have the double tax treaty to fall on, and Germany a couple of years ago, just around Brexit 2021, sharpened its national general anti-abuse rules in this respect, which means that the recipient of any dividends, royalties, or interest payments should be able to prove that that entity complies with certain stricter substance rules, and therefore it may make a huge difference whether or not the shares are held by an almost empty holding entity or maybe by the subsidiary of the holding entity in the UK, which has proper activities and personnel.
Indeed, and whilst we promise not to get into too much detail, if the UK company has any kind of tax advantageous arrangement in relation to investment it's received under, for UK listeners, EIS or SEIS or VCT regimes, or it has some sort of planning in place to reward members of the team with options under some of the tax advantageous schemes in the UK like EMI, then you really need to consider this type of change in relation to those regimes, because you may inadvertently cause a problem not only for investors but also for employees, and it's something worth considering.
Yeah.
That almost went very badly wrong. So yeah, these are the kind of things that yes, it's detail, yes, it makes it even more complicated and can put you off doing it, but it's worthwhile just going through a checklist for each of the entities, for you as an individual, really understanding what the effects are going to be, and the detail is there. We're trying to be quite light touched, but it is very much there. So whilst this looks like a great idea from a German perspective, it may have massive negative problems from the UK, but they're not unplannable around, if that's a word, and we can certainly work together to help you with that.
Definitely. One last remark in this respect, and then we'll forward to the last couple of slides, the last topic. For UK businesses, please also make sure to not rely on any statements of your UK advisor that your activities in Germany do not cause any permanent establishment for double tax treaty purposes, because your obligation to withhold wage taxes in Germany will not rely on a double tax treaty, but it will rely on the national definition of a permanent establishment, and that's you're there quite sooner than under double tax treaty.
Yeah, wage taxes are a real pain, and if you're coming into the UK or leaving the UK, making sure you get that balance right, making sure you're declaring it correctly in both countries is definitely something worth doing. Global mobility, as it's phrased, is a pretty complicated area, but again, pre-planning, understand what you're going to be doing, where you're going to be doing it, and you can easily work your way through it.
Yeah. So the family is now leaving Germany. We already touched upon it briefly. The family has some shares in some legal entities. The shareholdings exceed 1%, and they stayed in Germany for 8 years, so they fall within the scope of the rule. Now they have to be really careful of not triggering any exit taxes. They will basically trigger those exit taxes upon terminating their unlimited tax liability when they give up their domicile or habitual residence in Germany. Well, there are some structuring options available, so we will not go into them right now, but yeah, we'll be happy to discuss that on a personal level. After leaving Germany, if the family keeps German tax residency, they remain subject to German taxation. We already discussed that. A tax return still needs to be filed. If there's no double tax treaty in place, we have fun with the UK, so don't worry. But should you come from a country like Brazil, for example, where we have no double tax treaty, then the tax situation just remains the same. You just still stay fully subject to German income tax on your worldwide income. CFC rules, very important. regardless of the double tax treaty, they will usually remain applicable. State tax rules will remain applicable, and the further tax treatment depends on the double tax treaty. If you do not keep a place of residency in Germany and you also don't spend that much time here anymore in order to create a habitual abode, you have to be careful if you're a German national, so German citizen, because in that case you may become subject to an extended income tax situation to the extent you still have certain financial interests within Germany. So that can be for purposes of income taxation, but it can also be for purposes of estate and gift tax.
So it's very difficult to escape the UK German tax net, even if you've left the Germany, which is it's not dissimilar to the UK. So if you still have UK income arising from stuff that we tax, so like property income being the most obvious, then you'll still have a requirement to file a UK tax return. But if you don't have that stuff, then it's very possible to not have a UK tax obligation whilst you're alive. When you die, if you haven't picked up a domicile elsewhere in the world or the rules haven't changed, then you will have a UK inheritance tax exposure at that point on your worldwide assets, and you may not have lived in the UK for 40 years. So that's the kind of issue that we have at the moment.
Yeah, that's different than Germany, because the last bullet point on the slide, that's limited in time.
It is, absolutely. And ours looks like it may migrate to that. We may have a 10-year clock that's applied to people, which actually may apply to people like me. So I can go and live in another country, and after 10 years, I will be outside. But time will tell. We don't know yet. Okay.
Good. So, any questions? I don't see any in the chat, but anyone having a question, free to put them in the chat. And if not, thank you for joining us today. Happy to have been able to speak to you about this topic. Should you have any questions or follow-up topics, please do get in touch. For any UK topics, do contact Tom.
Please do.
And for any German contacts or also German topics or also EU topics, I'll be happy to put you into contact with our good cooperation partners within the European Union. So please do contact me.
Thank you very much, everyone.
Thank you.
Have a great afternoon.
Have a good day.